Hello, everybody, and welcome to another Southern California housing market update. My name is Stephen Meade. I am the broker of record here at Domicile Real estate for people who love houses, which hopefully is you if you are watching kind of our podcast. This is our Southern California market update. So this is mainly for Orange and Los Angeles counties. That's how we run most of our stats. If you are in the market to buy or sell a home, or you would just like some more information about homes in Los Angeles, Orange County, we would absolutely love to help you and lend you our expertise. So do not hesitate to reach out. Let's go ahead and get started because December is a very interesting month in California real estate. We don't quite have the snow seasonality that other markets do. Our weather doesn't turn completely crappy, but what we do get is very distracted buyers and sellers. And so traditionally, I have loved the month of December for buyers because I think it's a great time of the year really to kind of have the most leverage and negotiating ability. Like it's usually your best deals are going to be in the month of December. And for sellers, for some sellers, it's a good thing because for some sellers, you have a lot less competition as inventory starts to drop off. And if you have a unique home or something that stands out, this can actually be a good time of year for you. However, it's not a great time of year for all sellers. So let's go ahead and get started. One thing before we start is I just got back from an industry event where I heard one of the housing economists I actually like a lot. And for those of you who've been watching a while, you know this, my educational background is in economics. That's what I went to college for. And so, while I'm not a practicing economist, except in the sense of doing these housing market updates, one of the things I think I'm still pretty good at is evaluating which economists sort of know what they're doing and which are kind of full of bullshit. And, this particular economist is the current lead economist for the California Association of Realtors. I actually think he is very good and he knows what he's talking about. I don't agree with everything he does, but he had a couple of interesting things to say and had some interesting slides. And I'll try to weave some of that information in this week so that you can get some of the benefit of that as well. So let's go ahead and get started. So here's our first thing, right, is our total active listings. And guess what? They are starting to drop. And we saw this pattern begin 2 weeks ago gently, and it is picking up steam. And we saw this also in our first time home buyer market update. So this shouldn't be really a shocking surprise to anyone. We are at a point now where that 1 to 2 million inventory is heading downward. It is not wildly above where we were last year. And we've also got that under $1 million inventory has also turned the corner and is heading down as we head towards the end of the year. This is a normal thing that happens towards the end of the year. Inventory normally wanes, and then right as we go into January, it starts to pick up again. So that first week of January is normally the low point of inventory for the year. Now, what's interesting about this graph, right, is what is not happening. And normally in a year when you've kind of got some real building sort of market fundamental issues, you'll notice that this inventory will actually continue to build or it'll stay largely the same. So seeing this kind of a drop off really is an indication to me that we're in somewhat of a healthy market, maybe not quite as healthy as I'd like, but a generally healthy market. Now, if we look at our new listings, right, that is going to tell us a lot why that inventory is dropping. In the last 14 days, just look at where we are, especially compared to last year, right? So for under $1 million last year, we were right around 2,000 new listings in the trailing 2 week period. This year, we are around 1,100 under $1 million, and prices are largely the same. So what's interesting about that is, really this is a big difference. Look at how much faster this listing activity is dropping off versus last year. Last year, we didn't get to this point until, basically Christmas time. Now, if you look at our 1 to 2 million, that is also dropping off, and we are below where we were last year. So our level of homes coming on the market is significantly slower than this time last year, and not just a little slower, a lot slower, right? Like, I mean, we are down, gosh, 40% on that under 1 million, and we're probably down at least a good 10%, 15% on our 1 to 2 million. Now, if we look at our new escrows, those numbers are also down. But what's interesting is when you look at this, this is a far more linear progression, right? Like we see there was like a peak of home buying activity, maybe around that middle of March, which meant those deals all closed in April. And if you look here, it's really been a steady decline. And maybe there's a little bit of an acceleration here in this under 1 million in the last, 2 weeks. But I mean, look at what happened in the number of new listings versus the number of new escrows. I mean, it's clearly a much faster, more precipitous drop in the new listings versus the new escrows. And what does that do? That actually pushes our absorption rate up. And I don't think this is a holiday aberration. I think this is a real actual number that we are seeing here. That under 1 million market is, potentially a hot market, right? Especially for those homes that are desirable. And right now there is a very big difference between kind of the haves and the have-nots on that. So the home that everybody wants, it's like 90% of buyers are going after that top 10% of inventory, and then there's everybody else. And we're going to see some other evidence that in a second. Even this number on our 1 to 2 million is a pretty decent number right now. Now we're heading into these stats that are trailing indicators, right? These are based on deals that happened a month ago, right? They might have just closed, but these were negotiations that happened a month ago. Our upper end, 75th percentile end of the market, prices are flat, right? Our median end of the market, prices are down a little bit, flattening, and our entry level end of the market, that slid. Where were we a month ago? We were in a pretty bad place interest rate wise. And it's not surprising that this entry level 25th percentile market, you see this down here under 750, that market would get hit the hardest by where the market was. I think we're going to actually see these numbers level out and maybe a slight increase the next time we check them in 2 weeks. I think that those dropping interest rates kind of drove a little bit of a spurt of demand. Now, this is an interesting one, right, that tells you something about which homes are selling. So our absorption rate says that we're actually eating up a good portion of the homes coming on the market in terms of numbers, right? Like, so for every 10 houses that come on the market under $1 million, 9 of them go under contract, right? But it's not necessarily the 9 that just hit the market. And I think that's interesting. And we can see that because this percent still active after 14 days, this number actually went up. So what does it mean? It means buyers are being extraordinarily picky with their choice in inventory. They are not going after just the new listings, right? They're going after the homes that they want, the homes that they can get deals on. So you either have to be a compelling price point, right? Or you need to be a home that is inherently desirable. Now, if we look at our close to list ratio, this one's really interesting, right? Under $1 million, we're kind of hovering in that 98.5% range, but 1 to 2 million, look at where that leverage has slid, right? Like that's headed right down here to 98%. Remember, this is based on transactions that closed in the last 2 weeks. That meant they went under escrow 4 to 6 weeks ago. So you are seeing the reflections of where the market was, which may not necessarily be where the market is. I think we're going to see these bounce back the next time we check this in 2 weeks. If we look at our days on market for new contracts, this number jumped. So you might be thinking we've got some conflicting data here, right? We've got an absorption rate that's high. We've got a situation where inventory is starting to drop as we head towards the end of the year, but we're seeing homes are taking longer to sell. And again, that tells you a lot about which homes are selling and what kind of buyer behavior are we seeing. And basically, there's really 2 types of homes that are selling right now. First type of home that is selling are those desirable homes, right? They've got great photos. They're in a great location. They are homes that people want in whatever price range they're in. They're that sort of top 10%, maybe we'll say. But then the second category is homes that are being priced to move. Now, we're in an interesting time period of the year. I firmly believe that there are a lot more serious sellers as a percentage this time of year than there are at other times of year. Meaning, if there is a home that is on the market in the middle of December, that seller most likely wants to sell. So kind of getting to our three-way graph, right? This is kind of our general, where is the market in terms of affordability and health? And are we setting ourselves up for a ledge of unaffordability, right? That cliff that we're about to fall off. Well, you saw these numbers. They really stayed in line with one another towards the beginning here of our chart. And you see all through 2021, they're kind of growing. And then this gap developed, right? And then rents came up to meet that. Interest rates really went high and then they started coming down. And so what do we see? This gap is still a little bigger than I would like. And we saw this rent number kind of fall a bit. That's kind of an interesting thing in our market to actually see these rent numbers fall. I think a lot of that is the conversion of would-be sellers are just renting out their homes, so that it's increasing rental inventory. Maybe we'll do a graph on that to show rental inventory. But another thing that's important to note is that this payment index is, again, based on a 30-year fixed. I do not see most buyers using 30-year fixed rate loans. So this gap is closer than we think. It's not this far apart, and I don't think we're in danger. But the other thing that we get to point out here is look at what has happened as this rent has whittled down. It has actually come near in line with this inflation number. Now, typically over time, housing accelerates faster than inflation in general. So it will be very interesting to see when these new inflation numbers come out next week, where this inflation number hits. Finally, we've got our interest rate chart. And this, combined with a little bit of softening on prices, really indicates why we're seeing that payment number that we saw in this last graph kind of come into line. The reality is this is published once a week. I actually think, we're having lenders telling us that 6% at one point is now a semi-viable rate. So I think this number has actually even come down a little bit since then off that high point. And really, one of the things that a lot of economists are talking about is this idea of a sweet spot in mortgage rates in the eyes of consumers. And there are really 2 points in that interest rate sweet spot. Point number one is if they drop below 6%. There's a big psychological factor for a lot of buyers at that 6% point. And then the next big point is if they drop below 5.5%. Now we're going to have a little bit of an awkward conversation. I mentioned that I attended an economics update from an economist I actually like, who I think does a great job. His hypothesis is that the current rates, which have lowered from that 7% level, right? We got touched on 7% and we came down. He thinks that this reprieve is temporary and that in the beginning of the year, we are going to see those interest rates creep back up. And his reasoning is that the market has actually gotten ahead of itself, right? We've had some very good news for mortgage rates in the last month. About a month ago, inflation came in lower than expected. That gave the markets a huge boost in confidence. And mortgage rates are a lot about confidence in the future of inflation. The second thing that happened is last week, the Fed made some comments that they were going to slow down on raising the Fed funds rate. Now, slowing down does not mean not raising, and it doesn't mean lowering, right? It means slowing down. So last time around, we had a 0.75% hit. A lot of people are saying half this time, maybe a quarter this time. There's kind of economists are split on that expectation. But one thing you have to understand is that the Fed is going to keep going. And right now we have a situation where the 10-year Treasury bond, which is really what kind of guides mortgage rates, that number is less than the Fed funds rate. Historically, that is not a tenable situation. So imagine this. You have the Fed funds rate continuing to climb, and you've got this 10-year Treasury, which has fallen a bit. At some point, that 10-year Treasury is going to have to bump up a little bit. I don't necessarily agree with the severity that this economist said. I do think there is a period of time where that 10-year Treasury can be below, but it's not a huge amount of time and it can't dip way below. So understand that I don't think it's going to really get much better than it is right now. So I think we might have another month of interest rates like this, but I think we're going to start to see that market move upward a little bit and potentially more than a little bit coming into the spring. For first-time buyers especially, that just really kills your affordability. Another thing heard this week that I think is really important, right? If you are a buyer out there, is I think in the last 5 years, buyers have started to think of homes like buying crypto, like an investment that goes up and down wildly and you cash in. And the reality is that's not a great way to think about homeownership. Homeownership is a long-term hedge against housing inflation. Really, that's the best way to put it. It's also a forced savings mechanism. If you do not refinance, you will end up with a nest egg, even if you don't do any retirement savings. Your home can do that for you. Also, typically, homes do better in the long run than inflation. Owning property does better than inflation in the long run. So that's all I've got for you. Questions, comments, we love them. If you are thinking of buying or selling real estate in Orange or Los Angeles counties here in Southern California, we would love to work with you. Definitely reach out to us. Don't forget to like, subscribe, and hit that notification bell, and we will see you again real soon.